What would you say are the top 3 things every buyer should do before calling a lender?
So what goes into that number that someone is qualified for? How do you determine what that number is?
If somebody is an authorized signer on a credit card, so mom and dad's card, that is reported on their credit report. I think the biggest oh crap moment for most people is that the 4 things that go into your cash to close.
Credit score has a huge impact.
Yep.
It can cut your fees in half.
We're going off-roading with real estate.
Taking it out of the Tahoe and bringing in backup.
Welcome to Under Contract, Taking Backup.
Here we are. Monday morning, we're going to do some jawing with our backup guest.
Yes.
Taryn Schwartz.
Thanks for having me.
Thanks for agreeing to come on. The viewers want to know a little bit more about you. I know you're not originally from the area.
No.
As we were just talking about the Seahawks, because that's your team, because you are originally from
Seattle. I started in banking when I was 18 in Seattle and then moved into commercial lending. And then when I moved to New York in 2012, I started in residential. So I went from teller trainer, commercial, and then to residential.
So how long have you been in banking now?
Well, I'm 21, so
I was going to say, you moved up really fast. You kind of did what Chelsey did. You started at the
Bottom, now you're at the top.
bottom. I didn't want to say bottom. You got your foot in the door, and then you're all the way at the top.
I would say bottom.
You would say bottom?
Yeah.
Okay.
Yeah, started in the back, processing, closing, and then I was supporting 2 people and they left quickly. And my boss basically said, "Are you ready? Sink or swim?" Then he came back and said, "I'll give you a raise if you want to stay in your position now." And I was like, "Oh, so is it that bad on either side?" And then decided to go for it, and here we are.
So a lot of people might not understand how the process works or what that means. So when you say you were in the back end, you were in processing and underwriting, what does that mean?
Processing and closing. So basically, the originator, pre-quals people, they're the ones with the relationships with the realtors, the attorneys, the community members. Once the file goes to a complete application, so once people are under contract, they've turned in all their documents, then it goes to the processor who kind of does all the behind-the-scenes type of stuff. The closer prepares the closing documents for the buyers to sign, and really not a lot of contact with the buyers or the realtors or, whatnot. So more back office stuff, learning how it works behind the scenes.
So like your support staff, sort of.
Support staff, yep.
And because you're so smart, you moved up so quickly. I remember meeting you when you were the processor, I believe. Yeah. So you started out when you moved here from the West Coast. What bank did you start at?
Elmira Savings. So
that's right. Sorry.
I was with Elmira Savings Bank up until they got bought out, so just shy of 10 years.
So I started with Elmira Savings Bank, and that's where I met you.
Yep.
And then you went to Community Bank because Community Bank bought Elmira Savings Bank.
Yep.
And now you are at Tompkins.
I am at Tompkins Community Bank, formerly Tompkins Trust Company.
See, it's breaking my heart that they changed their name because Tompkins Trust alliteration. It's breaking my heart. So besides lending and being at Tompkins doing residential mortgages, what else do you do in the area? Tell us a little bit about yourself, Taryn. The people want to know.
I'm a mom.
She's a hockey mom.
I'm a hockey mom. I have 2 kiddos that are 8 and play hockey.
Fun fact.
Husband who's a first responder, so he works a lot. And camping and hiking and watching Seahawks.
So camping, hockey, hiking, you're just out there. Fun fact, our sons have the same name.
They do.
They share a name.
Yep.
I remember you were afraid to tell me that's what you were going to
I know. Yep. I think I might have texted you from the hospital, actually.
Did you?
I think I did, didn't I?
Well, how many years has it been now?
Probably about 8.
So I was asking how many. They just had a birthday.
Yes.
That's right. We just had Black Friday. Let's bring up Chelsea's topic here.
Yeah. What's your biggest fear with Black Friday and buyers?
Opening up the new credit cards, trying to save that, 10, 15%, putting balances on those credit cards. Not only does that increase their monthly debt, but also can drop credit scores, which can impact qualification, but also pricing, which would be your rate or your closing costs.
And that can affect someone who's already under contract.
Yes.
So not only is it going to potentially affect someone who's looking to get that pre-approval and buy the house, but even if they are under contract, everything's moving right along. If they open that credit card, because the bank does that final check.
Yeah. So not every bank does the final check. Some do. But a credit report in general is good for 120 days. So if somebody takes out another credit card, so even if they don't put a balance on it, but their credit is checked, that's going to drop their score. If they take out that card and they put a balance on it, that's going to drop their score. So if their credit report expires and now the bank has to repull, even if they're in application and they are approved, that could potentially impact their approval, but also the rate and closing costs that they can get.
This is great because everybody thinks that they know how mortgages work.
Oh, everybody, because their uncle bought a house 25 years ago and it's the exact same.
Without Googling.
Fax my application over. Sorry.
Fax. Sure not carrier pigeon? Just fax? Okay.
Oh, maybe carrier.
Okay. So there's a lot of misinformation or confusion sometimes about how mortgages work, especially now in this era, post-COVID, let's say. So part of that, I think you just answered part of that. So if, say, I came to you and I'm like, I want to buy a house. I know nothing. What if I think that I can't buy a house? What if I'm like, I don't have a down payment, or I'm self-diagnosing myself that I don't have good credit or I don't have a good down payment or anything? What would you tell me?
I think the first thing is you don't know what you don't know. So if you aren't trying to get pre-qualified and having somebody look at your credit, if you're not exploring grant options for first-time home buyers or low down payment options, then you have no idea what's out there. Don't talk to your friend or your family member that bought 10 years ago or even 3 years ago, because things have changed so much. There's so many new things out there or things that maybe not out there anymore. You have to start somewhere. So I think starting with a pre-qualification where somebody looks at your debt or your income and says, maybe you don't qualify right now, but here's what you need to do and here's what you would qualify for. Or based on your income, here's what you could qualify for if we can do this with your credit score. And then down payment options, there's as little as 3% down for non-first-time home buyers. There's 100% financing options for first-time home buyers. So buyers who have no idea what's out there, they have to start somewhere. And so that would be my biggest piece of advice, is to call a lender, or even INHS does credit counseling, Ithaca Neighborhood Housing. So start somewhere and just start doing the research. I think first-time home buyers either come in with no knowledge or knowledge overload, where they've done so much research, they're like in paralysis because they think they have to know all the things. But yeah, just starting with calling somebody.
Now, if somebody knows what they want to spend monthly, they're like, this is what I can afford monthly. Would you say it would be a good idea to then go to a lender and say, here's the payment that I want to be in, and work it backwards? How do I get to that point?
Yes. So a couple of the questions I ask up front is, what is your target monthly payment with taxes and insurance? So I think figuring out your budget is really important before you meet with a lender. How much can you afford for cash out of pocket? So besides just your down payment, there's also the closing costs, the prorations of taxes, and then your escrow deposit if escrows are required. And then, what does long-term financial goals look like for them? And that could include the housing, but that can also include, like, maybe they have a high credit card they need to pay off. And those are all things that a lender can take into consideration when they're figuring out the best mortgage product, the best mortgage payment. And even if somebody says, I want my monthly payment to be $1,500, I'm going to get them to that point. But if they qualify for a little bit more, I'm also going to tell them that price point as well.
So what goes into that number that someone is qualified for? How do you determine what that number is?
The biggest factor is going to be debt to income ratio first. So first, I'm taking their gross income, looking at what their other monthly debts are, and figuring out how much they have left in their debt to income ratio to qualify for. And then I back into the purchase price as far as what they have for down payment, what type of products they're looking for. So it's kind of like fitting everything into a puzzle piece. From there, if their credit score isn't great and maybe we need to increase the rate a little bit to absorb some closing costs or vice versa. It's just kind of piecing the puzzle pieces together. And then second is going to be the credit score itself. And certain products require a higher credit score or certain products allow for a lower credit score. So then those products will also have different debt to income ratio requirements. So USDA, for example, is a government-backed 100% financing. It has a little bit stricter requirements on debt to income ratio. So if somebody's trying to go for that product, they're going to qualify for a little bit less. So it all just depends on what their goal is and what products they're going to be going for.
Speaking of credit scores, everybody thinks that's the number one thing. So say you have two people applying for a mortgage and one has a really good credit score, one doesn't have the greatest credit score. How does that work?
So the pricing, which is the closing costs and the interest rate, is going to be based on the lower of the two borrowers' score, but the stronger borrower is going to impact the qualification.
What is the FICO score? Like what actually goes into it? Because we always talk about credit score and I mean, you could
Nobody
really
knows.
Nobody really What actually goes into what makes up the credit score?
So the biggest thing is late payments, and I think that's what most people think about. So a late payment on a mortgage, of course, is going to have a huge impact. A repossession of an automobile or anything huge due to late payments is going to have a major impact on your credit score. But another thing that a lot of people don't think about on their credit reports is how they use their revolving debt. So if you have 5 credit cards and they're all maxed out, when you go to apply for a mortgage, in our eyes, we're like, whoa, you're maxing out your credit cards here. Why do we think you can qualify for a house? That also impacts your credit score. So anytime your revolving debt balance is 30% or higher of the limit, it's going to be negatively impacting your credit score. Anytime it's 30% or lower, it's going to be positively impacting your credit score. So if somebody has not great credit and they are trying to improve it and they have maxed out credit cards, my first advice is going to be to pay those down to 30% or lower. So start with 1, pay it down to 30, go to the next one, pay it down. And I'm not a credit counselor, like certified or by any means, but this is just from experience in classes and helping clients do that. If your credit card is over the limit, so sometimes you buy and you have it at the limit, but then there's a fee assessed to it and it's over, that really hurts your credit as well. And then of course, bankruptcy and foreclosures and those things are a whole nother ballgame.
So one thing that I hear a lot, and I don't know if you do too, Chelsey, is that this, I don't know if it's a myth or not, is that folks, they don't want to come in and get pre-qualified or they don't want to talk to a lender because they think talking to you or someone means that they have to get their credit pulled and then that hurts their credit.
So talking to someone does not have to involve a credit pull. We can't do a full pre-qualification without that. But talking to somebody about your goals, and I just did this actually for a client of somebody in your office where she told me exactly what her income was, all of her debts, just very honestly, listed everything out. And I told her based on that, what I thought she needed to do, what she could pay off to qualify for where she needed to go, and she's going to come back in 12 months. So it doesn't always involve a credit pull. If we do pull your credit because you want, an exact answer, that's going to be a more concrete solution. It typically drops your score between 2 and 7 points. And it's going to vary depending on the borrower and their credit history and what that looks like. And then after 120 days, it usually starts to go back up again.
It does take forever to get that back up.
It does.
But man, does it drop quick.
I know, right? Like it takes forever to go up, but boy, that second, like we're going to drop it. We're going to drop it. It seems a bit arbitrary too.
So that's something that buyers should also be aware of is even if you have a game plan in place to pay this off, and it's going to take time to get to that point. You can pay it off the very next day, but it's not going to skyrocket a week later. It's going to take time and you kind of have to wait.
So another thing that this just came up, so this is what made me think of it, is if somebody is an authorized signer on a credit card, so mom and dad's card, that is reported on their credit report. So if that person's credit card is maxed out, I don't know that it has like such a huge impact as if it was their own, but it is showing up on their credit report as well. So potentially impacting their credit score.
So if you're a co-signer.
No, just an authorized user. You're not even responsible for the debt, but you have a credit card to that account. It is showing up still on your credit report.
I see. So if you're an authorized user on a card and the person that is in the
driver's seat.
and they max it out and aren't very responsible, that could affect the authorized user because it shows up.
Yep.
Interesting. So one of the things that I hear a lot is people, or I see a lot, or I read a lot, is people that don't have credit. What about people that don't have any credit history?
It's so weird because in other countries, no credit is a good thing. But in our country, like if you don't have any debt, that's negative. So there's options for alternative credit where people can document that they've paid rent or they've paid a phone bill that wouldn't normally show up on credit. Or, anything that they've paid for the last 12 months, like Netflix doesn't count, but insurance counts. So things like that.
TV subscriptions.
No.
Apple subscriptions. That stuff doesn't count?
No, but insurance, rent payment would be the best one, honestly. And for every lender's going to have different requirements, but typically we'd want to see at least 2 for 12 months. But funny story. So I had this guy who paid off his mortgage in full, like zero balance, owned his home free and clear 6 months before coming to me, pull his credit, and he doesn't have a credit score already. In 6 months, he lost his credit score because that was his only debt. So it happens, like, it's weird.
That is bizarre. You would think that that's a good thing. In that case, it just comes up. It's not a 0 because a 0 would be terrible. You want a 0, but it just says any like you don't exist. I'm sorry, you don't exist in our financial world.
So I could see his credit history. He just didn't have a score. So I could see that he paid off his mortgage.
This is fascinating. So how important, if you were to line it up from 1 to 5, 1 being the most important, 5 being not important, how important is the credit score or the FICO score, what we call the FICO score, when getting a mortgage?
I would say very important because it's going to impact what programs you can qualify for. It's going to impact pricing. There's certain pricing that every bank prices differently, but I'm going to just speak right now on Freddie and Fannie have this certain fee called the loan level price adjustment. Some banks charge it, some banks don't. If they're selling to Fannie or Freddie, they are either adding it into the interest rate or they're absorbing it, which is probably not a lot. But if you have a credit score of a 740, which is a great credit score, your closing cost on a $200,000 loan is going to be $1,750. But if your credit score goes up to 780, that fee is cut in half at $750.
So 40 points cuts your fee in half.
And a 740, in my opinion, as just a normal person, is not a bad credit score.
So credit score has a huge impact. Yep. It can cut your fees in half. Wow. We've had this discussion before because you've come to some of our team meetings. What's going on in the world of credit scores right now? Because I think you had given us some information at one point. So is there an update on what's going on in the world of credit scores right now? And is it trending that they're going to go away?
Not go away, but it's supposedly going to be easier to get a credit score. So shorter credit history requirements, a little bit more lenient. And right now, most banks are pulling a tri-merge, which is 3 credit scores. Potentially next year, a lot of banks could go to a 2-score model. The transition, though, I'm not sure how long it's going to take because, that involves banks updating all of their systems, their requirements, and that sort of thing. But there's 2 new models coming out, credit score models coming out next year, and that should make it easier for clients to get and build credit.
So in 2026, there's new, okay.
At some point in 2026.
At some point. Okay. Wow. So I'm curious now, what did you do with this guy that had no credit score, had an NA?
So his wife added him as an authorized user on her credit card, and 2 weeks later, 3 weeks later, we repulled credit and boom, we're good to go.
So that's one way to fix history if you don't have any credit history. So you could have somebody add you as an authorized user.
Yes, but with him, I don't know about anybody without any credit history with him because he did have a credit history. He had just paid off his mortgage 6 months ago. With him, it was really easy, and I think his credit score came back at like a 780 or something.
Okay, so what about folks that don't have a history? What would you recommend that they do?
Open a small credit card, anything to start building for 12-ish months. I mean, we can always do the alternative credit route I mentioned, but better pricing, better credits or better interest rate, better closing costs is going to come with a higher credit score. So, $500 credit card that you just put your gas on. And then make sure you're not paying it off before the bill cuts, though, because that's what's going to the credit bureau. So if your bill every month is showing 0, then nothing's reporting. But
Right.
just slowly start building credit. Maybe take out a small personal loan. Not too much, too fast, but something to just start building your credit.
Wow.
So kind of talking about like down payments and what you would need for your closing costs. So I know you and I have worked a number of times with gifted funds. So how does that kind of play into?
So gifted funds are allowed from a family member. So it can be by marriage, blood, or adoption. And it has to be documented that it's coming out of the donor's account. So this is pretty heavily regulated because they don't want illegal funds. They don't want to basically clean money with buying a house. So dirty funds cannot be used to purchase a house.
So like Ozark, you don't want to.
Yes, like Ozark.
That makes sense.
So we have to document the funds coming out of the donor's account by the easiest way, honestly, is a canceled personal check, because when the check is canceled, meaning it has cleared their account, there's a bar on the back of the check saying that it's cleared their account. So we're assuming that it was in their account first. They're saying those were their funds, and we're documenting the buyer depositing those funds into their account. The donor cannot go to the bank with $1,000 in cash and buy a certified check. If they use a certified check, we have to get a bank statement from the donor showing the funds coming out of their account. So we have to show that they had the money in their account.
Gotcha. So you can't just pull a wad of cash from underneath the mattress.
No. I did have somebody pull a wad of cash out of their glove box once, and he said that, and I said, well, what is this money from? And he goes, well, it's my glove box money. And I said, your glove box money? He goes, doesn't everybody have a wad of cash as glove box money? And I said, no, they don't actually. And he's like, yeah, every paycheck, I just put $20 in there and that's my glove box money. Yeah, that doesn't work. I also had somebody take a picture of $100 bills laid out on the table, and they're like, here's my documentation.
Here's my proof of funds.
And I'm like, that doesn't work.
Told you.
Doesn't work.
Can't copy. Yeah.
So funds have to be documented from acceptable sources. So gifted from family members. Loans from retirement, we don't count the monthly payment against the buyer. So if you take a loan from a retirement or withdraw from your retirement, that's good. Secured personal loans are fine. We do have to include that monthly payment in the debt.
Yeah.
Unsecured loans are not fine. So if you go take out an unsecured $10,000 loan, I can't use that as funds to close.
What do you mean unsecured?
So some banks will do an unsecured loan. They'll just like a credit card advance, or like take out a $10,000 installment loan with no collateral. There has to be something securing it.
Okay. So I can't just go start a GoFundMe page to raise money for a down payment for a house?
GoFundMe is not allowed. No.
Darn it.
They can get
Somebody can gift them some money for down payment, but there's very strict rules that apply. Like no GoFundMes. It has to be a family member.
Yeah.
I actually had this question. I think we talked about this when we had a guest on the previous episode. We had said a friend, but you can't. It has to be a relative.
The regulations say that it has to be a relative. So each bank, though, could make an exception on what they will allow. We recently allowed a person's partner's mother, so technically not a family member, but we felt like the partner had been, they'd been partners for long enough that felt valid to us. So every scenario is going to be different. The family member is just the general requirement, but of course there's case by case scenarios that we looked at.
And if one tip that, anybody who's looking to gift that fund to, say, their child or something, I always recommend talking to their tax consultant.
Yes.
Because there is a specific amount that you are allowed to gift tax-free. But we're not tax consultants. We're not. So, but I always say, call them up because they can walk you through it. And there is those tax-free funds that can just be handed over.
And I say the same thing. Call your accountant.
Yes.
That is not me.
Yes, we know just enough to be dangerous. But again, it's not going to hurt. Just like you said, it's not going to hurt anything to talk to somebody to get the information.
And honestly, what people are doing is building their team. They're building their realtor, their financing, their attorney, their accountant. Like, you're building a team of people that you can call on who is they're experts in things that you are not. So you're not hurting anything. You're helping yourself.
Exactly. What is the most creative but legitimate way someone has come up with their down payment? What have you seen?
This is an interesting question because now nothing surprises me. It's not, I don't think things are creative anymore because I feel like I've seen so many things, but multiple secured personal loans, multiple gifts from family. One person just said she started with her grandma and worked her way down the list of her family members for gifts. I mean, she was getting like 1,000 here, 500 here. People who own multiple properties tend to take equity out of one property to buy the next property and continue to do that.
If you're looking for a house, you might want to try a duplex because here's another way, correct me if I'm wrong, that if you want more money to qualify towards purchasing, towards your income, your debt to income, like you said, find a duplex.
Yep. And the requirements on that are going to be different as far as what can be used and if money can be used depending on the product. So if people don't have a landlord history, some products might not allow it. But yes, in general, a duplex is a great option. Oftentimes requires 5% down instead of the 3%. And if it's an income restricted product, the rental income also is going to come into play with that.
So if you're a first-time home buyer, you could try to find a duplex that's rented at least on one side and owner occupy the other, because the rent from that other side can help you qualify for the loan.
Yep.
Right?
Yes. You just have to be able to move in within 60 days of closing. If there is a lease agreement in place, the appraiser is going to do a market analysis to confirm that it is a legit market rent. If it's lower, then we will use the lower of either the market analysis on the appraisal or what is being currently charged. But the appraiser is going to confirm, what is the market rents for that unit.
So if someone needs a little bit of a boost to show that they have more income in order to purchase or qualify for more in a purchase, they could be looking at duplexes.
Yes.
And then use that history of rent from one side to help them qualify, because that will be income in their pocket. They can be like, look, I have this extra stream of income now.
Yep.
So that means I can afford more.
Yep. If there's not a renter in the other unit, we will use 75% of whatever the appraiser says the market rents are. Right off the bat, we take 25% off for vacancies, repairs, and that sort of thing.
Yeah. So that when we say house hack, that's what we mean.
Yes.
That's a great way to get into a house. If you are feeling priced out of a market, or if your debt to income, which is one of the things they use to qualify, is not as high as you would like it to be, that's a great way to do it. Now you have to be prepared to be a landlord.
Yeah.
Right. I think we just worked one a couple years back where the clients, they already had a house that they bought 10 plus years ago, and they bought it with a loan, and they had a very small mortgage left. And their interest rate was fantastic, and they wanted to buy another house, but they didn't really want to sell the house that they currently owned. So I think they worked with you. They got a lease agreement in place, and then you used that to basically pre-approve them for the new purchase.
Yep.
And now
it's another house hack.
House hack.
Yeah.
Yep.
Yeah.
So if, that's always an option too. If you don't want to sell your house and it's not contingent,
right?
That sale.
Getting a lease agreement in place, 12 months. So I would say I am seeing more gifts than before. Probably half of the first-time home buyers, which is a lot more than.
Wow.
And sometimes it's smaller. Sometimes it's $5,000 or $1,000. Sometimes it's $50,000. So it really just depends on the buyers, obviously. But yeah, I would definitely say I'm seeing it more.
Wow.
Have you seen an increase in concessions back from the seller to buy down rates?
No, I have not seen concessions come back since COVID when everything got crazy. And in fact, buyers who need concessions to get their cash to close down are being told by, not you guys obviously, but by realtors basically, like, we're not going to get a house if you have to have concessions. So it has been a struggle for people that might need it.
I've heard that. No, I've heard that. I've come across some buyers who have actually said, yeah, I'm switching realtors because this is what my realtor said to me. And I've seen a lot of stuff online as well, in forums and stuff. Speaking of concessions, because not everybody understands what concessions are. Do you want to tell people what concessions are?
Yeah. So concessions is basically an amount back off of the purchase price. So now, would you consider buying down the interest rate the same as seller concessions for closing costs?
Yes. So it's the buy down is a closing cost. So the concession would be the seller contributing a portion of their proceeds towards the buyer's closing costs.
Okay.
A rate buy down is a closing cost. So that would be a concession.
Okay.
So you just get to choose what those concessions are for. Can they be specific and say, I am choosing this $6,000 to go towards this closing cost?
So they can say, how much does it cost to buy down? That's what I'm going to contribute. But in the bank size, all of the closing costs, the cash to close or the cost of the house is lumped together. So your purchase price, your closing costs, your prorations of taxes, and your escrow deposit is all a cost to the buyer. And then from there, we're crediting the loan amount and whatever other credits are coming. So it's not specific like to one thing, but the buyer or the seller could say, well, the cost to buy down the rate is $2,000, so that's how much we're going to give towards closing costs. So
now, would that, because with seller concessions, for a buyer to qualify, each buyer could qualify for something different amount-wise. What is it, like 6%? So
depends on the
max
down payment. So 9% is the max. If someone puts 25% down, they can get 9% seller concession.
Okay, but what if... So here's a question, because I thought it depended on the mortgage product.
It does.
And the person and what they qualify for.
It does.
But most people doing concessions don't have a down payment. That's why they're doing concessions.
So at 25% down, somebody doing concessions is probably because there's a repair or something, which the bank doesn't want to know about. La, 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 la.
Nope.
So normally it's 3%. Government, so FHA, VA, and USDA is 6%.
Okay. So is that something that a seller can offer like upfront?
Yeah.
And they wouldn't have to worry about, so say instead of a price drop, a seller could say, I'm offering a 3% seller concession back to be put towards buying down the rate. They can do that.
Yep, absolutely. And the biggest thing to remember is that the appraised value has to come in at the gross purchase price. So if it's $200,000 with seller concession, so the seller's walking away with a net, just say 194, it has to appraise at the 200, not 194.
So basically, and what I tell people, and correct me if I'm wrong, is concessions are just a way for buyers to mortgage their closing costs.
It is.
I'm super simplifying it, right?
Yes. Yeah. It gets confusing for buyers, though, because if they haven't talked to a realtor yet about negotiating that into the contract, they're like, well, why can't we just add it to our loan? And then it's like, okay, so you've been talking to your uncle again. Yeah. Or just 25 years ago. But it has to be negotiated in and actually has to be coming back from the seller, so to speak. But yes, in short, it is essentially financing a portion of those.
And the only reason I say that is because it can be confusing. So for round numbers, when somebody says, I'm going to give you $100,000, but of that $100,000, you're going to take $6,000 of it and give it to my bank to cover this portion of my closing costs. So in reality, the seller is only getting, did I say 6,000?
194.
They're only getting 94. I didn't know if I said 4 or 6. They're getting 94,000.
Yes.
In reality, the seller's only getting 94,000. However, the buyer is still on the hook for the $100,000 mortgage. Am I right?
For the purchase price would be $100,000. If they're financing 100%, then yes, they're still
right. If they're financing, I'm going.
But they're still on the hook for the full purchase price.
They're on the hook for the full purchase price. I'm super simplifying it.
Yes.
Okay. Yes, if they have zero money down.
Yes.
And the concessions are their only money down. Okay. Yes. In addition to gifts, I know, especially with first-time homebuyer programs, and you have other programs, and I know specifically Tompkins has a grant program. INHS has grants you can use as secondary financing. What about buyers using grants?
So there's quite a well, I shouldn't say quite a few, but there's a few grant options in our area. So you said INHS, their grant programs change every year. So I'm hesitant to speak exactly to their terms, but they have ones that are basically free money that go away after 5 years. They have ones that you pay back when you sell the house. And as far as restrictions on those, I think it's different depending on where the funds are coming from that they're getting. There's another grant called the Homebuyer Dream Grant that's funded by the Federal Home Loan Bank of New York. The restrictions on those ones are you're supposed to keep it for 5 years and then it's forgiven. If you sell within those 5 years or you no longer own or occupy, you do have to repay the grant back at a prorated basis. And it's on an application. So if you're going to pay off the loan, we have to submit to Federal Home Loan Bank, and then they tell us what you have to pay back on that loan. So that would be kind of the downside to the free money, so to speak. But I think for most first-time home buyers, if you're buying a house, hopefully you're going to plan to stay in it for 5-ish years, and then that's money that's just in your pocket. The grant programs are all income restricted at different levels for different counties. So Tompkins County has some of the highest income limits, and then the surrounding counties are going to be a little bit lower. And it looks at household size as well. So if you have a bigger family, they're going to be a little bit more flexible. Even if you're expecting, that is counted as your family size as well. So those programs that change on a regular basis and the income limits change on a regular basis is a good reason why anybody who thinks they might be close needs to reach out and check.
The Community Housing Trust homes from INHS, that is another way to get into housing affordably if somebody needs to.
Absolutely.
So,
and I love working with INHS. They're great to work with, and I think benefit buyers that couldn't purchase anywhere else or a house. You know, one of the buyers that I have that's purchasing them is a young family that was looking at like not great shape houses out in like Newfield and just not houses you want to bring a new baby into or start a family in. And now they get a brand new house in Trumansburg, and I think it's fantastic.
Yeah, because these are brand new homes that they build. Yeah. And the way they keep it affordable is that it's like a land lease. Yeah. So you own the home and everything in the home, and you have to get qualified just like you would with any other property, except that they're income limited. Yes. And they used to only be for first-time home buyers. But for these Trumansburg townhomes, they opened them up to non-first-time home buyers. It's a way for buyers to build equity because they keep the prices below the median, I would say here. They keep the prices below the median. Not only that, the taxes are low as well because property taxes also play into what you can afford. And these housing trust homes keep the taxes lower as well.
Yes.
But then you're in them for a couple of years and you build your equity so that then you can move up to your next home. And then you're capped at what you can sell these homes at so that it stays affordable for the next buyer.
Yep.
But they do this because of grants and that's how they're able to do it.
Yep. And some of the buyers, or I would say probably a lot of them, are also getting assistance from INHS. So they're getting down payment assistance as well as the lower purchase price.
And even if you're not buying one of the INHS homes, you can get down payment assistance from INHS, yes?
Yes. In any county that touches Tompkins. So a lot of people think that it's only for Tompkins Ithaca neighborhood housing, but it's not.
All of the surrounding.
Yes.
Yeah, it's Tompkins, Cayuga, Seneca, Schuyler, Tioga, Cortland.
I think so.
Yeah,
I don't really work for INHS, but I believe it's correct.
I've done enough work, but
yes, I do.
Is their grant program similar to like the American
Homebuyer Dream?
Yes.
So INHS's is different because theirs can change depending on where their funds are coming from. Okay. So whoever's funding their grants can put certain requirements on it. The Homebuyer Dream Grant is basically money just for the people who make 80% of the median income. And they also have a few grants, not a ton, of people who make 120%. So they have a little bit higher grant option as well. So INHS is hard to talk about because it changes.
Right. Now, I know we had talked about kind of in the past how, the start of the new year, that's when new grants come out or the new money comes out. And then once it's out for that year.
Yes.
Are both of them very similar where it's kind of capped at that amount that they can give out?
I believe INHS like applies and gets different funding throughout the year.
Okay.
The Homebuyer Dream Grant, so in 2026 is going to start on February 9th. First come, first serve. You have to be under contract to make a reservation. And then once that money is out, it's gone. Like they set a certain amount and then it's over when it's over. But INHS, I believe, continues to apply and get additional money.
So if someone thinks that they could possibly qualify for that grant, they should probably reach out to their lender.
Now's a great time.
Get their pre-approval, start looking, and then they can apply. Once they go under contract, they can apply for that grant.
Yes.
And
because it moves really fast and it is first come, first serve, I am telling my buyers right now to get everything turned in that we are going to need. So that does include a first-time homebuyer course, which can be taken online or through the INHS first-time homebuyer course.
Speaking of getting everything turned in, we were just having this conversation. I'm going to skip ahead to this because for folks looking to buy a house, they have to be an active participant in buying a house. And you just talked about getting things in on time. There are a ton of documents that people have to fill out. The days of no-doc loans are gone.
See, I don't think that it's that much.
Well,
and everything's
because you do it
electronic
every
now
day.
too.
Yes.
But you do it every day. That's why. 2
pay stubs, 2 W-2s, and maybe 2 to 4 bank statements.
So this is all this stuff that people have to get to you.
I mean, there's might be certain circumstances where there's more, but in some first-time homebuyer W-2 employee, I don't need a ton of documents.
Let me put it this way. I have sent clients to Taryn very, very last minute, kind of on the clock. Like,
it's your favorite person.
It's 7 o'clock on a Sunday. What are you doing? I've never.
As long as the Seahawks aren't playing, right?
And I send this person to them or to her, and they get all of the documents in very quickly. And next thing I know, my email is buzzing with the pre-qual letter.
This is a timely process because we hear this all the time. When am I closing? What's going on with closing? Well, if you don't get the documents to your lender that they need in time, then there's nothing they can do.
Yes.
So
we have to turn everything in. One thing that I think realtors and also buyers don't understand is when we have an address, technically the mortgage goes to a live application. We have 3 days to send numbers, an official loan estimate to the borrower. We have to decision a loan within 30 days. So we have to say, yep, you're approved. And this is a formal application, not pre-qual. Yes, you're approved, or no, you're declined. Buyers have to get their stuff turned in. Otherwise, we're decisioning on what we have if they're not turning in any of their documentation. We can also decision it as an incomplete application. So once they go under contract, not only does the time start ticking for attorney review, structural contingency, but now the banking, who's probably a lot more, I don't want to say a lot more regulated, but heavily regulated, also starts. We have to follow certain and satisfy certain regulations, like the ability to repay. So we're not asking for W-2s or tax returns because we think it's fun. Like, we have to prove that you have the ability to repay this mortgage.
Right. So that would technically fall under the financing contingency, which we typically give about 35 days for. I'm going to pivot away from grants real quick because because not only have I sent you last minute pre-approvals that are, on a time crunch.
Yes.
But I've also worked some deals with you where we had to be very creative, specifically for LLCs.
Yes.
So I know we actually did one a couple years back where, tell me about how that works with like an LLC mortgage.
So we don't do them residential at Tompkins. So really all I can speak to it is that not every bank does residential financing with LLCs. I know there is one lender in Ithaca that will do them. The difference is going to be the closing costs and the interest rate are going to be significantly higher. The last I heard, you still had to have your personal name on everything. So your LLC could be on the title, but your personal name still had to be on everything else. Right. So depending on the purpose of having the LLC, I think a lot of people are opting to just go commercial. But most residential bankers or most residential lenders are going to require you to go commercial, and they're not going to finance an LLC.
There's a difference between residential and commercial. The reason why somebody purchasing a home as an LLC would want residential is because you get
Me.
that, number one. Absolutely, hands down, number one. I can attest to that. Number one, you get a lower down payment. You don't have to put 20% down. With a commercial loan, I understand you have to put 20% down.
And fixed rate versus adjustable. Some commercial only has adjustable. Some commercial only allows for 20 versus a 30. So there are benefits. It's just not very typical.
Yeah, because not everybody is a first-time home buyer, right? That's what we've been talking about mostly. But yeah, so if you wanted to purchase in an LLC, that's different.
Mhm.
So we were talking about like down payments and the barriers to entry into housing. There are some, and you were talking about closing costs.
Yes.
But there are more costs to buying a home than just the down payment. And I know we touched upon them a little bit, some of them being closing costs. And I know we explain this a lot all the time is when we say closing costs, people are like, oh yeah, here's my down payment. It goes beyond that.
Yeah. There's 4 things. Well, I say 4 things that go into your total cash to close. So the down payment is what everybody thinks about. Your closing costs, which is the actual cost of doing the loan. And then the escrow deposit. So if your lender's requiring an escrow account, which is a bank control account that you're going to pay into for taxes and insurance, you have to actually deposit into that account to get it started so that when those bills come due, we have money in there to pay them. Like if you closed right now and town and county's taxes are due in January, without a deposit, there's nothing in there to make that payment. So we have to have an escrow deposit. And then the main one that some bankers don't even disclose to buyers is the prorations of taxes. So this is something that you pay whether you finance or pay cash. And it is the amount you have to reimburse the seller for taxes that they have paid, but now you are going to own the home. And what I've been seeing with some non-local lenders, some big lenders, is they don't show that fee on their loan estimate. So one scenario I had, the buyer sent me the loan estimate and he was like, well, the interest rate it was like 0.01% lower, but my cash to close was lower. Well, when I looked at it, he was actually paying almost $9,000 for that interest rate and the prorations of taxes weren't even listed. So his total cash to close was listed as lower because they weren't even adding in this additional, it was a large purchase. I want to say it was like $7,000 of prorations of taxes. And he didn't know because he was a first-time home buyer. So that fee is something that people don't think about. If they've never bought a house, they don't know about. And I think that is like a sneaky hidden fee if your lender is not disclosing it because.
So when somebody goes online and they're like, let me type in, and rather than going to a local person and they're like, just shoot me out some numbers, that big online national lender is not going to have all these nuanced numbers.
Yeah. So this big bank actually does have a local person. They just also didn't know how to calculate the taxes. So I see with, your online bankers and your large bankers, they aren't disclosing everything correctly, like fee-wise, but they're also not calculating taxes correctly. So I want to say in this scenario, the taxes are like $300 a month lower than what they actual current taxes are, not proposed on the purchase price, current actual taxes. So those, I think, to me, are the biggest hidden fees. And then, I can't speak to other lenders and what they're charging, but when people are shopping around and they say, well, I found a better pricing elsewhere, my response is always like, let me take a look at it. I'm going to tell you if it's better. I'll try to match it if I can, or I'll tell you if it's better and, I'll see you in the grocery store next week.
Yep.
Like, I'm never going to try and, put another lender down, but also like, let me look at it and see what's going on. One of the questions I ask up front is, is there a specific area you want to be? Because the village of Trumansburg versus the town of Ulysses is going to have different taxes, just like the city of Ithaca versus the town of Ithaca and so on. So I want to put numbers together for any of the areas that people are potentially interested in. And then at the purchase price points that they might be interested in so they can see what that looks like. And then the cash to close worksheet or the loan estimate, unofficial loan estimate is going to break down and itemize those closing costs as well as the prorations of taxes that I'm estimating.
A big thing that I found with buyers, first-time home buyers. They're going to a house that hasn't been on the market in a very long time.
Right.
The assessed value is much, much lower than the market value. And 2 years down the road after they purchase it, the assessed value and the tax rate, everything bumps up. So now, say they were paying $1,500 in taxes based off of that one assessed value, and now their taxes are $4,000.
Right.
Are you taking into consideration that tax jump for the assessed value in your numbers?
So when somebody goes under contract and I'm calculating their taxes, what we collect at closing is going to be a conversation with the buyer and myself. And it's going to depend a lot on what the difference is between the purchase price and the tax assessed value. Also what county it is in, because Seneca and Schuyler County are a lot different than Tompkins County. If it's minor, like say it's just $20,000, the buyer, I really am leaving it kind of up to them. Do you want to start with your current assessed value, knowing you're going to have to make a deposit and your payment's going to adjust? Would you rather start with your purchase price? Anything larger than that, I'm going to be strongly encouraging them. I can't require them to, but I'm going to be strongly encouraging them to base it on the purchase price, just knowing that that jump is going to come. We can only keep so much money in the escrow account at one time. And so every year they're doing an escrow analysis of the escrow account. And if we have too much money in there because say we calculated on the purchase price, we're giving that money back to the buyer or the borrower. I would then encourage them to deposit it back because they can turn around and put it back, but we have to show we gave it back to them. Until that assessed value adjusts accordingly. But that's a big conversation that we have before preparing disclosures and, establishing the mortgage, is making sure they're prepared, what they think that the taxes could go up to. And when I'm providing those numbers, I'm saying, here's what taxes are now, but here's what they could potentially go up to.
Right. Yes. Unfortunately, that's a conversation that we have every time we show a property that they're really specific, like they're interested in.
Yeah.
That this is the assessed value. This is the purchase price or the list price. And there's a huge gap. Like there is always a chance that a tax assessor is going to just look at what you paid for it, and that's the new assessed value. And then that's what your taxes are going to be.
I always prepare people to be like, just expect your taxes to go up.
Yeah, I don't say there's a chance. I usually say it's probably
it's gonna happen
in Tompkins County at least.
Yeah, not right away though. So I get the question a lot, or like, okay, but isn't this going to go up immediately? I'm like, no, that's called spot reassessment, and that's illegal. You can't do that. But there is a process every year where, at least Tompkins County I know of, I can't speak to any other county, Tompkins County assesses every year. It's not spot reassessment. They don't do it right then and there when you close. It's every year, and there is a grievance process. We'll have to talk about that at some point. But was there ever like the biggest oh crap moment that somebody had that they were like, I can't believe this. This was a total shock to me. Why didn't you tell me this? And you're like, I have been all along. Like, what have you had that?
Not that intense, because I feel like I'm pretty upfront with most of my buyers from the very beginning. But I think the biggest oh crap moment for most people is that the 4 things that go into your cash to close. It's not just your down payment. It's not just your down payment and closing costs. There's 2 more buckets of funds that we have to collect at closing. And then also people moving here from other states. It's the taxes and how high the taxes are.
We've been through the pandemic. We've been through how things have changed on our end in terms of purchasing. I've been in it since 2005. So I saw the 2008 market. I saw the 2011 market. What are you seeing, or what can you speak to has changed every market?
So I didn't see the 2008 market in residential. I was in commercial. As far as changing with the pandemic, so I think the biggest thing is a lot of the process has become digitalized. I have clients I don't even talk to on the phone through the entire process. Like they just want to text or email. That's not by choice, by the way. I would prefer to talk or meet in person. Meeting in person is like not even a thing anymore. It's 1 out of every 25 clients, I would say now, want to meet in person. So I think that's like the biggest thing. Underwriting requirements have changed quite a bit. So for example, verification of employment. We used to have to call 10 days before closing and talk to somebody and say, does this person still work here? Is everything the same? We can now get the most recent pay stub closest to closing date. I don't know that this is a factor of the pandemic, but appraisal waivers is like a huge thing now. It's happening more and more. Working remote is another change. I think employers are seeing that people can do their job anywhere. So people are employments in California and they're working here. Now, we do require that their employer provide something that states that they can work here, and there's not like a time limit on it, but still an option. I think that, in 2020, we saw the rates go to the lowest they've been, and then they basically almost doubled up they did double. They went up to almost 7% at one point. And so I think that for people who didn't buy, now their pre-qualification has changed drastically.
Right.
So just a lot of changes in that aspect. I think AI is going to change a lot of things with financing.
Interesting.
So I think that we went from a time where they tightened everything up and mortgages came almost unattainable. Like buyers were more protected because you had to qualify, but they became kind of unattainable for certain people, to a time now where we're starting to see them loosen up the reins a little bit. Certain investors are saying we're no longer going to have a minimum credit score, which was a 620. And certain people are reducing the minimum down payment. So as I mentioned, every lender has different products, but Freddie Mac, for example, used to require 15 to 20% down on a multifamily owner occupied, and they just reduced that to 5%. Wow. So, or I shouldn't say just, this was a few months ago, but things like that, we're starting to see loosen the reins a little bit. And I think that as we move into an AI world where financial statements, tax returns, bank statements, everything's digitally reviewed and probably more accurately, maybe more accurately than an eyeball can. I think it's going to start to even loosen up a little bit more. And that's just my own opinion. I think we're going to see more and more. The credit report that we talked about earlier, allowing people to, I think one of the models, people had to have a 2-month credit history or a payment history. That alone is loosening things up.
Yeah.
Misconception that I hear a lot from buyers when I suggest a buyer reach out to a local bank. And I hear time after time after time, well, there's got to be some sort of kickback. There's got to be something that, why are you encouraging us to work with local banks? And I give them 1,000 reasons why, I tell them you can go to the big box mortgage companies, you can go to the big banks, you can do a local, you can go to anybody. Have you ever come across that where you've heard something very similar?
I have. And I actually just had a very negative experience where somebody was working with an online lender and she was mad at her realtor because the listing agent wasn't going to accept the pre-qualification letter. And this honestly is, I don't want to say a pet peeve, but it is frustrating to me because somebody has been pre-qualified and now the seller won't accept that pre-qualification letter. So now I, on a Sunday night or, Sunday morning, am working hard to pre-qualify them, and they are like mad at me. Like it's my fault that the seller's not accepting their pre-qualification letter from somebody who's sitting in Minnesota who probably doesn't know what the taxes look like. So I do hear that as well. And I think the biggest thing is just you have a relationship with local lenders and you trust them. I know there's some online banks that you could get a different person every single time you call. And how do you trust somebody that you've never worked with before? I love being a lender in my community because I am financing or providing mortgages for people that I see on a regular basis. Our kids play sports together. I see them at Wegmans. And to back that up, I also don't want to screw up because I have to see you at Wegmans and I have to see you at my kids' sporting events. And so, I'm going to try harder because I am in this community and I care about the community. And somebody who sits at an online bank in Minnesota doesn't care about Ithaca, New York and what's happening in our community.
What would you say are the top 3 things every buyer should do before calling a lender?
The first thing I think is they need to figure out what their goals are. So what do they want their monthly payment to be? What are they comfortable with? Their cash to close amount, how much can they come up with, whether it's a gift or whatever that scenario may look like, taken from retirement. And then what kind of area and what kind of house are they looking for? So if they want the duplex or whatnot, all of those come into play when we pre-qualify a buyer. So just because I say you qualify for $1,500 a month, that doesn't mean that that's what you're comfortable with. And I want to help buyers get comfortable with their purchase. So they need to know what they're comfortable with first. So the other thing is unfreeze your credit if you haven't already done so, and pull your free annual credit report if you haven't. See if there's anything on there that doesn't look right, doesn't look good. And then stop taking out any new debt. So don't come qualify for a mortgage and just have purchased a car last month. Or if you have, make sure that you can afford both at the same time. So maybe talk to a lender and then purchase the new car to make sure you can afford both.
Awesome.
So we talked about the 3 things a buyer should do. What are the 3 biggest red flags? Don't do this.
The biggest thing is don't take out any new debt. So whether you are thinking about buying a house, you're pre-qualified, or you're under contract, until you are closed on that house, do not take out any new debt unless you've talked to your lender. Like obviously things happen, your car breaks down or something, but that's going to impact what you qualify for because now you have another monthly payment or the monthly payment is changing. So don't take out any new debt without talking to them. Do not deposit large lumps of cash.
What? No glove box money?
No glove box money into your account without documentation, because all large deposits, and a large deposit is considered to be anything that's 50% of your gross income. Anything that's not documented, we can't use. Don't deposit large lumps of cash. And I think the third thing would be not to quit your job.
That's a good one.
Yeah. Or if you're going to change employment, then also maybe before you make that leap, reach out to your lender to see what might change. If you're going from a W-2 employee to a 1099, that's going to be an issue.
That's a question.
So
Thank you for prompting.
Now, sometimes, like we said, life happens, and sometimes you may be let go during the process. What would you suggest the person do?
Reach out as soon as possible. If you can get another job quickly, we could potentially save the deal. But if you don't have anything lined up and there's not a co-bar or there's no way to afford it, then unfortunately the mortgage is going to be declined.
But basically, come back to you.
Yes.
We have a lot of first responders in our area. Do you or local lenders that you know of, are there programs specific for those first responders that they can
There are going to be programs that are going to have certain discounts. It's going to be different for every lender as far as discounts to either private mortgage insurance or closing costs or whatnot. So they'll just want to reach out to whoever there. Yep.
But it is an option.
It is an option.
And I hear there's some programs or mortgages for teachers as well as doctors or physicians.
Yep.
Yeah.
Yes. Every lender will have different options if they have any.
We gave a lot of information today. What is the one thing that you want a listener to take away from today?
Don't be afraid to try and get started. I think that people are embarrassed of their credit history, or they just don't know where to start, and reaching out to our local realtor or local lender is a good starting point. And if you're not where you need to be, we will get you there. I have people that I've started with and they don't buy for 12 or 24 months, and it's a process. And don't ever be ashamed if you don't have a down payment or if your credit's not perfect, because life happens and we know that. But you have to start somewhere, and like just start.
I love that. I love that.
Thank you so much for joining us today.
Thanks for having me. We can't wait to come back.
Thank you, Taryn Schwartz. Seriously, thanks.
Welcome.
I know that you love doing these. Thanks for being our backup guest today.
Yeah, you're welcome. Thanks for having me.